All right. Good morning. I am Jeff Mechanic. I am a senior staff member here at the FASB, as well as the chair of the Not-for-Profit Advisory Committee, and I'd like to welcome everyone to our March NAC meeting. Want to welcome all our members and observers, especially our new members, Rebecca Block, Rick Cole, Susan Eichhoff, Vince Melanti, Dawn Stark, and Amy West. I also wanted to welcome our board members, as well as the FASB staff who will be participating, and everyone who is watching us via live stream. Two of our members, Mayan Fox and Jen Hoffman, will be unable to join us today, and I know Chris Dutch, you indicated that you'd be leaving in the middle of the meeting for another commitment. So again, welcome everyone. So let me briefly talk about our meeting objectives. As with the last couple of NAC meetings, much of the current meeting will involve our 2025 agenda consultation. In particular, some projects that were added by the board in response to feedback that we received. We'll be talking about those later in the meeting, as well as some issues that we heard from the consultation that we expect to bring to the board in the coming months for agenda decision. We'll be talking about some of those as well. We'll also have a cost-benefit discussion on the current expected credit loss model on CECL with regard to not-for-profits as the staff in that area continues to move forward on our post-implementation review. And we'll discuss a project that came to us through the EITF and some research that's being undertaken in connection with the work of the Private Company Council. Both of those last couple of items were briefly discussed at the last NAC meeting. But first, we have our standing agenda item on emerging financial reporting issues in the not-for-profit sector. And we just discussed that pretty robustly in the closed session. And much of our discussion ended up being about impediments to communicating financial health and performance of organizations, particularly around the matter of operating measures. Let me start off, because there are a bunch of people who spoke here, but let me start off with the person I started off the last session with, which is Kerry Chikerico, who was with us for a closed liaison meeting that we had with the National Association of Colleges and University Business Officers in NAC back in February, where we talked about this a bit. Kerry, I want you guys to speak for yourselves a bit here. Let me start with Kerry, and then I'll call on others who also weighed in here.
Thanks, Jeff. And as Jeff mentioned, during our NACUBO Accounting Principles Council meeting with the FASB staff and some of the board members, we were really focused on our concerns around the limitations of the current reporting model and our ability to effectively communicate our financial health, particularly around the absence of a required calculation for an operating measure. It's an elective calculation right now in our financial statements. There's little consistency across the not-for-profit space about how that might be calculated. And so what we're finding is that so often there's this perception of wealth in our financial statements because users are automatically going to our change in net assets at the very bottom of our statement of activities, which in addition to our operating measure also includes things such as our investment return on our endowment, changes in our retirement plans, as well as our restricted contributions. And so all of those things are giving a perception of wealth and liquidity that can be distorting how our actual operating measure and our financial health appears. And so that was a very healthy conversation that we had with our APC meeting, as well as earlier today. And Jeff, I'll certainly add that our colleagues on the call also had a lot of opinions as well.
Okay, thanks. As did a lot of NAC members here. So Andy Gutierrez, I think you next weighed in.
Yes, thank you. In the provider health space, we see this a lot, looking at the operating measure versus the strong balance sheet. How do you link that and let the readers see truly what's structurally happening from an operating measure perspective? And it's not uniform across the industry at all times, so definitely looking for clarity in that regard.
Cheryl Madden?
Yes, thank you, Jeff. We discussed a little bit about the project that took place about 10 years ago related to possible MD&A. I know the AICPA had issued a white paper just to kind of revisit that a little bit in regards to the type of information that gets reported so that the users of the financial statements have more information regarding maybe the current environment or some type of unaudited operating measures that they're able to disclose just to provide the reader with some additional information.
Chris Dutch?
Yeah, I had basically two comments. One is that Carrie talked about, one which is that the optionality to choose an operating measure, which exists in the guidance, though, also just promotes lots of inconsistencies. Some do, some don't, and even those who do, even within the same sector, often don't have the same definition. So anyone who's looking across, they don't really know what they're looking at, and they can't really compare across. And my second point was also that because of the just structure of the not-for-profit statements where we have the unrestricted and without donor restriction, that and because those are so different than any other set of statements, they're structurally difficult to follow. And for those who aren't steeped in not-for-profit accounting and maybe don't completely understand restricted funds and how they're used, it's hard to necessarily know what you're looking at and know what's important in your statement of activities.
And again, you've indicated that an operating measure might help in terms of focus on that.
I think an operating measure tied in with maybe an MD&A or something with liquidity, I think those things kind of all need to travel together. I don't think an operating measure solely is the answer, because that needs to also be understood about what people are looking at. But I think providing a context around that would probably be helpful.
Rick Cole?
I had just suggested possibly additions to the 55 section of the codification, where the examples implementation guidance is, that shows the idea of maybe moving restricted gifts down into a non-restricted area, so that if a operating measure excludes gifts with restrictions, any totals, if you use a column or approach, would still be pure to what the operating measure results should be.
Diane Manning, you talked about what you've been doing as a user.
Yes, as a user, we spend a lot of time getting to the operating measure to understand the financial health of the organization, breaking out the kind of one-time items and investment returns and so forth. But it's really helpful for us to know that number in our analysis for credit requests.
Pete Hugo?
I was provided an example of some of the confusion that can come from restricted net assets being released when a capital asset is purchased through a fundraising campaign. Those funds would accumulate when pledged through the net assets with donor restriction, and then when the asset is placed in service, it flows into without donor restriction, which some could perceive to be a positive operating result, while that depreciation expense happens over the next several years instead of a current expense.
Again, hence, you said you encouraged clients to put that type of release in the non-operating section.
Correct. So there's inconsistency in that, but some we have encouraged to put that release from restriction in the non-operating section so as to not distort that operating measure.
Robert Dobbins, you had some observations about, I don't think it was specific about operating measures, but a sort of EBITDA equivalent or something like that.
Yeah, sort of like Diane, the idea of recurring and getting rid of one-time items and specifically the unrestricted activity, so it's available for general obligations, I think is certainly, the focus that we have on and trying to determine, sort of what operations ultimately makes available for debt service as we're in the debt market as a user.
Rebecca, you had some sort of conceptual observations here.
Yeah, I was just bringing up from the conceptual framework perspective, from the user perspective, we want to make sure we are providing decision useful information for users. So it sounds like delineating an operating measure separately from other measures that would increase net assets could help increase decision usefulness for users.
And I might just also turn to Christine and Sue, who are two board members present, to see if they have anything here to add to about the discussion that we've heard.
Do you want to go first, Sue? Sure. One of the things that I asked a question about in the previous session was really around the accounting for contributions, and it does seem like one aspect of the challenges in trying to understand the financial health of an organization, and Carrie talked about this a little bit in terms of how to separate that out and so forth. And I just wondered if, we've heard some different things from different organizations about whether that provides useful information or not, and maybe a question to the group as to, whether it's still fit for purpose in terms of the way the recognition and measurement works today and the timing of that recognition. So I would be interested in some feedback on that.
Christine?
Yeah, and I can just add what I heard, and also one of the questions that I asked was whether educational materials might help, but I think the answer to that was pretty much no, that it's really about the consistency, and that those educational materials would not drive towards consistency. I agree with Rebecca in that if we look to the conceptual framework, the objective clearly would say we need to be providing useful information. I think the challenge that we have, though, is our presentation chapter is completely silent on the structure of financial statements and how things should be bucketed. And just in the half hour that we were talking, I heard some saying, well, maybe recurring should be above the line, non-recurring should be below the line of operating income. I heard one say maybe interest, depreciation, amortization, I won't say taxes because it's not for profit, should be below the line. I heard someone else say unrestricted above the line, restricted below the line. And I think that's the challenge that we face when we go down this path, is that we're very much dependent on feedback to figure out what that operating measure should look like. So I guess one thing I think that would really help the board would be just some consistency in the feedback that we get if the board were to take on a project on an operating measure. And I don't know how you all get there, but that's, I think, the thing that really created our problem of getting the last time we did this over the finish line, is that we're very dependent on feedback because we don't have a conceptual basis. And if we get very diverse feedback, it makes it really hard to make progress.
And I had planned, and later on we're talking about liquidity and operating measures as part of the agenda consultation topics that we're interested in feedback about. But I briefly reminded, as Christine just alluded to, that we did attempt to do something here about a decade ago. We did propose, it was actually a principles-based approach based on mission and availability. And there we had incredibly mixed feedback. There were folks who agreed with that proposal, although they may have had some implementation questions. There were others who sort of agreed, but they thought that our particular proposal, where we also laid out separately the effects of internal designations and transfers and appropriations resulted in something was a bit too convoluted, and therefore kind of defeated the purpose of the principle-based approach that we proposed. And then there were others who said, don't go forward either because this is too difficult to implement, or because business entities aren't required to do it, so why should not-for-profits be required to do it? So we had such mixed feedback that we didn't finalized something a decade ago. What I'm hearing here is maybe a renewed call for this, but again, as Christine was alluding to, we would have some challenges, and we'd love to hear some thoughts. And we could do maybe have some discussion here. We certainly can have some discussion later on when we're talking about operating measures alongside liquidity disclosures. But I particularly wanted to see first, I guess, from Carrie, if in your view, we've captured enough here, in terms of what Nakubo brought to our closed discussion. And then I want to hear from other board members to see what kind of questions or things they might want to ask having to do with this discussion at this point.
Jeff, yes, I think this completely encapsulates, and I think Chris really laid it out nicely how MD&A, liquidity, as well as our statement of activities are all intertwined and how we can look at them collectively
Okay.
with consistency running through the vein right there.
Yeah. And again, as we'll talk about later on, when we get to those topics, liquidity or the disclosures around that area was something that we also worked on a decade ago. We did finalize some stuff there. We're hearing some mixed thoughts now about how well that's functioning in practice, especially the qualitative aspects about it, but we'll get to that later on. Just wanted to see if any of our board members who weren't part of the closed session, or Nellie or others, Nellie, you were part of the session, sorry, what had any questions at this point, anything they wanted to tease out here?
Hey, Jeff, it's Rich. It was just kind of following up on Sue's observation on contributions, which I assume means pledges, unconditional pledges. And is the timing right when they're recorded? Is the level of effort associated with assessing collectability worth it? I heard someone mention we look healthier sometimes than we are. And I was kind of curious if a pledge where the funds won't be received for years, is that part of that issue or not? So I was just curious the direction of that conversation.
Harry, I think you're probably the best person to answer that. Maybe others who were part of that closed session, because we did have, I think, some mixed views on that.
Rich, really, what for us, the concern is the fact that the contribution is going to sit in our asset, and then it's sitting in our net asset, so it's sitting in our equity, and so it's giving a perception of wealth for something that we will not recognize into revenue, recognize into our operating measure until we, satisfy the related obligation. And so really a conversation around, should those live in net assets with donor restrictions, or maybe more appropriately live in a liability?
So not the unconditional pledge being recorded for the fund received.
No.
You don't have any issue with that?
No.
Okay.
Well, again, just to be clear here, this conditional pledge, it shouldn't be in net assets.
I was talking about unconditional.
Unconditional, okay.
Unconditional, yeah.
Okay, thanks. Carrie, let me just want to tease one thing out on you there. And this goes back to Chris Dutch's comment about liquidity disclosures. I mean, that is the place where we are providing, or preparers are providing information to users about the types of assets, financial assets that are not available within the next year for general expenditures. And presumably, if users are going to the notes, that's where they get that type of information. But what I remember hearing during the Kubo meeting was that some were observing that many users were not going to the notes and therefore not really focusing on that information.
That's exactly right, Jeff. And sort of, again, having that connection between our net assets and what we're disclosing in liquidity is so important. And so, again, because they can't make that connection, they're just going back to the two core statements and saying, okay, here are our net assets. And there's a perception of wealth because we have this large net asset with donor restriction number, which, again, really in our minds is more of a liability than something available for use.
Okay. All right. Any other questions here? I mean, again, we're going to return later on to liquidity and operating measures as part of our agenda consultation with topics. But I just want to see if there's anything else anyone wanted to tease out here. Okay. If not, let me now move on to our second topic, which is agenda consultation. And as I mentioned when I was talking about the meeting objectives, the staff is continuing to do research on and then bringing to the board the various issues that we heard in last year's agenda consultation. So far, at least as of I think before yesterday anyway, the board had added 7 projects to the technical agenda, some of which we'll be discussing later in the meeting, and has decided not to add several others. In this part of the meeting, we'll be asking NAC members for some additional detailed feedback on several issues that haven't yet been brought to the board. Lauren Motley, who I'm going to turn to in a moment, has one general issue to talk with us about, and then Jeff Cabello and I will have some not-for-profit specific issues, most of which have been raised in prior NAC meetings, and we just discussed one or more of those. So let me turn to Lauren Motley, who is going to talk about public entity definitions.
Thanks, Jeff. Good morning, everyone. The purpose of this session is really to discuss the feedback that the FASB has received on the definitions of a public entity, non-public entity, and a public business entity as part of the 2025 agenda consultation and other stakeholder groups. In the 2025 agenda consultation, it observed that stakeholders had indicated the FASB should reconsider the definition of a public business entity. Stakeholders had noticed that the definition is expansive and costly for certain types of entities to apply the accounting guidance and the requirements for public business entities. GAAP also includes multiple definitions of a public entity and a non-public entity, which are used to establish recognition, measurement, disclosure, and effective date requirements. Some stakeholders have suggested that the FASB should reduce the number of current definitions to minimize confusion and misunderstanding by investors, preparers, and auditors when applying GAAP. In the meeting materials today, you can see an excerpt that we've included from the October 2025 board meeting handout that discusses the feedback that we received on the various definitions and the recommendations for the types of changes to the definition of a public business entity. And here on slide 6 that's in front of you, you can actually see the definition of a public business entity. As you can note in there, not-for-profit entities, including not-for-profit conduit bond obligors, they're excluded from the definition of a public business entity. However, we note that not-for-profit entities are included in some of the other public entity definitions and the other non-public entity definitions, depending on whether the not-for-profit is a conduit bond obligor. Some not-for-profit stakeholders have noticed that the lack of comparability in certain requirements and effective dates between conduit bond obligor not-for-profits and other not-for-profits. And some of those stakeholders would prefer that not-for-profit conduit bond obligors are just treated more consistently with all not-for-profits. Generally, those stakeholders raise concerns about comparability with peer financial statements and resource challenges when inconsistencies in standard setting occur. So with that, I might just turn to the next slide on slide 7, which just has the discussion questions for the NAC members today. So just reading those for the group here. Question number 1 is, what complexity, if any, results from there being multiple definitions of a public entity and a non-public entity in GAAP? Should the FASB prioritize a project that seeks to reduce the number of definitions? And if so, should the FASB consider replacing the definitions of a public entity with a public business entity definition? And then the second question for discussion is what concerns do NAC members have with the definitions of a public entity and a non-public entity, or the public business entity definition?
Thanks, Lauren. Let me throw it open to NAC members to provide some feedback here. Thanks, Cheryl. Appreciate it.
Yes, thank you, Jeff, and thank you, Lauren, for that outline. I would agree that there is some confusion out there. So naturally, as a not-for-profit, you're scoped out of the private business entity definition. But as you had mentioned, when considering the issuance of public conduit debt, like a public bond, you could then flip into the reporting requirements of a public entity, which of course result in applying all of those accounting and disclosure requirements for public entities, in addition to being required to adopt new guidance earlier than your peer not-for-profit organizations. So an entity who has never issued debt before, the research component is a bit overwhelmingly administrative in order to even go through and determine which disclosures are required to be adapted from like a look back perspective as you're going through all of the different ASCs. And even to further complicate that, even if you issue a public tax exempt bond, it may not necessarily result in becoming a public entity for the adoption of those reporting requirements, because the trigger really is whether or not the securities are available to the general public or are trading publicly. So depending on how restrictive you can be on the front end regarding how public your bond issuance is, you could actually result in, being considered a direct private placement of a public tax exempt bond, and therefore the criteria doesn't necessarily apply. Although as a not-for-profit, I realize that at times there's an additional cost that's associated with that type of issuance. It could be, a slightly higher interest rate for a not-for-profit. So there's definitely a trade-off there in order to avoid the necessary additional work with those disclosures and in adopting new guidance earlier than others. So I do agree that the definitions should be clarified, or perhaps just all not-for-profits in general should be scoped out of the definition, regardless of whatever type of debt that they issue.
Go on.
I would probably just repeat a lot of what Cheryl just said. I would say, being on the auditor side, we spend a lot of time with the education with our non-for-profit entities with that new definition of public business entity as to when they need to adopt a certain standard. Because I think the first couple that came out with that new terminology was, I think, lease accounting and RevRec, and a lot of not-for-profits with conduit bond obligors end up being scoped into that earlier effective date. That I think going forward, a lot of them, when I see that public business entity, they just assume, oh, I'm still in that scope because I have conduit debt and I would be a public entity. So I do think there's still a little bit of confusion for those not-for-profits that do have conduit debt as to, do I fall into the effective date of one standard versus the other? One is not clearly scoping in not-for-profits with conduit debt. So, but I agree with Cheryl. I think the inconsistencies at times as to certain not-for-profits are scoped in, sometimes they're not, does provide that year of implementation, at least a year, maybe 2 years of inconsistency with certain standards. But I think those are probably the two key areas. It's going to be certain disclosures are more expansive at times, or when do I need to adopt? But I just think there is a little confusion. It does. I know I spend as an auditor trying to spend time with my team and my clients, educating them when is their year of adoption. Obviously, they can early adopt, but I think there is confusion because of the closeness in public business entity and public entity, and with a couple of standards that came out that sort of scoped in those not-for-profits with the public business entities, that there's still confusion within the marketplace.
Other feedback here. Robert Dobbins, can I ask you to weigh in a little here on because I know that you deal with the rating of public debt or various bonds.
Yeah, I'm not sure. I'm going to be very helpful, right? So we only engage with not-for-profits that are, issuing in the market and are reporting, financials on EMA. And so, I'm not sure, specifically around the public business entity definition, if it has relevance in the work that we do. So, I don't really have a view on this.
Others one way, and go ahead, Christine.
So, Robert, I think the thing I think about as a board member is, let's say that not-for-profits were always scoped out of public entity, regardless of whether they were conduit, bond, obligors. Would that be a problem for you as a user if the effective dates are delayed, or if there is somewhat less information being disclosed because of disclosure relief that was provided to entities that are that are not within the public business? You know, if we just have public business entities be the group that is held to the standard of more disclosures and earlier effective dates.
Yeah, no, thank you for that clarification, Christine. So, you know, if we're looking at this just from the context of, you know, how quick entities have to adopt, you know, new accounting standards, I would say that anytime there's an accounting standard change, it is, you know, sort of very laborious for us to update our systems in order to, you know, sort of modify the metrics and the financial information that we're analyzing. So, you know, essentially the bottom line is the more time for adoption, generally, the easier it is for us. The more often everyone is on the same time frame in which they're adopting the changes, the better, right? From our perspective, because if you have certain issuers, you know, adopting standards, you know, 1 year and others are delayed for another year or two, that transition phase impacts our ability for consistency and analysis between issuers. So I would just say that, you know, we wouldn't necessarily have a affirmative view on, you know, accelerate adoption or not. You know, I think we're more indifferent on that. It's more about the certainty in which the adoption's happening and that it's consistent across the broadest set of issuers.
And I guess I have a follow-up question there, Robert. Are your teams or others in the marketplace comparing not-for-profits with public debt to registrants or others who corporate and business entities with public debt?
At least within our you know, sort of set up by sector, it's sort of self you know, peer comparison within like entities. And so, you know, while we have you know, for-profit, not-for-profit healthcare, for example, you know, oftentimes we're only looking at, you know, the subsets of not-for-profit against not-for-profit, for-profit against for-profit is much more common. And it would be a lot, while there is some comparison between for-profits and not-for-profits, it's not, you know, so the primary reference point for us.
Well, Rebecca Block.
Yes, so I'm just following up on Robert and Christine's perspectives, and also actually your question, Jeff. Just saying that we should be focusing on, once again, on user needs. Having multiple definitions certainly increases the complexity, will reduce that comparability, and which will impact the decision usefulness for users. So I guess my just a thought is really focused on accountability to users, on public accountability to users. So rather than just pulling out nonprofits from that definition, looking at nonprofits as far as their public accountability to the users. How much are those users using those financial statements? And maybe that should play a role in determining the effective dates for those entities. And, you know, obviously streamlining a definition between sort of like a PBE and a non-PBE could be, you know, and then even maybe a secondary look at accountability from there would just be a thought. so that you're not just taking a whole segment out, you're looking at what their accountability to their users is.
Thanks, Rebecca. Anyone else want to weigh in here? Lauren, any further questions of the NAC here?
Good, that's been great. Thank you very much for the feedback.
Okay, terrific. All right, I'm going to turn to Jeff Gabello, who's going to tee up the first three not-for-profit specific topics having to do with agenda consultation.
Okay. All right, thanks, Jeff. There are no slides for this. There was, I think we had a little bit of a, not a memo, but some excerpts of the agenda consultation ITC, and also the feedback on that question related to below market or interest-free loans. This was actually specifically asked in the agenda consultation document. It relates to guidance if for programmatic loans, when you are, when you're giving a below market or interest-free loan, and determining what portion would be an inherent contribution. That guidance, the inherent contribution guidance is in subtopic 958, but the guidance on, how to determine what's the inherent contribution portion of that loan is in the AICPA guide, which is non-authoritative guidance. And so I think the feedback on that was that this was a low priority for standard setting, that the guidance, although not authoritative in the AICPA guide, was useful, and there were no issues in practice, and there is some judgment that needs to be involved here because of the varied nature of these types of programs and loans to lendees, or I don't know whether they're donors or borrowers or both, but that there really wasn't a need for the board to provide any standard setting here, because there also is some judgment that needs to be applied. So we just wanted to bring this back to the NAC members to see if they had any additional feedback for us, in addition to what the comment letter feedback in the ITC.
Any further feedback on this? Thanks again, Cheryl.
Yeah, no problem. Thank you, Jeffrey and Jeff. This is a little bit of a twist on this. I do agree that the information available in the AICPA guide is incredibly helpful for those who are making below market or interest-free program-related investments. And as an organization that makes such loans, I receive a lot of audit confirmation letters on our PRIs. None of them have ever asked about like the imputed interest rate. And so, and I'm not sure that it's actually discussed during the due diligence process with the counterparty. So my guess is that everyone determines their own contribution calculations on whatever rate they're using. So I guess one question I would have is whether or not it was intended for both sides to be in balance, like the world's books to agree to one another or not, or if that's not something that is even relevant or needs to be researched further.
Pete, you go.
Hi, from the AICPA not-for-profit panel or expert panel role that I have, we've spent a lot of time on this. Chris Dutch and I specifically, as the revisions that were made to the guide, Chapter 8. Samantha Cox is here from the AICPA also. This has been a big focus over the last couple of years. So Cheryl, to your point about the accounting world being in balance, I think a lot of private foundations view it as fairly immaterial to their overall activities. So it's not as big of an issue. And I think on the other side, they're generally going through their own process and not communicating. Now, maybe whether they should be is a good question to ask. But there are going to be some more changes to Chapter 8. We participated in a FINREC meeting last week to talk about some of those changes that are, I would say, more simplifying some of the information. But that just want to mention there will be some updates coming out to that part of the guide again here shortly.
Any other feedback here? Okay, if not, Jeff, why don't you move on to your
Okay.
next couple issues?
Okay, great. Thanks, Jeff. So next slide, please. So this is other feedback that we've heard regarding the not-for-profit sector, and this has come up a couple of this issue. It's sort of a two-part issue, but sort of part one is, I would think, the bigger part is the navigability of the not-for-profit consolidation guidance, and then we'll talk about the mergers and acquisitions guidance in the following slide. But this issue here is the consolidation guidance. So we've heard at NAC meetings and previously, and in previous years, so this just didn't come up recently, that the not-for-profit consolidation guidance is hard to navigate. And a lot of that, I think, the staff thinks or believes has to do with the nature of not-for-profit consolidation guidance is kind of is different from that of business entities. And there's the control sole corporate membership or controlling financial interest plus economic control, economic interest, and then there's the variable interest entity. The VIE guidance is not included, but the special purpose leasing entity guidance that was superseded for business entities is still applicable for not-for-profit entities. So it's a bit of a mixture of different sets of guidance over different times, and so we just wanted to understand, and I think we've heard, I think, more in generalities that the guidance is hard to navigate and non-intuitive outcomes could be reached. However, in previous outreach, we've heard, it's hard to navigate, but we generally get to the right answer. And so we just wanted to understand better what is it that we can do from a standard setting perspective to improve this guidance. Now, I know this might be not the right forum. We could also talk about this offline as well. But just generally, what is it that we could make, what is it that we can do to make this better? So if we go to the next slide. Oh, at M&A, I'll tee these up together. So we also heard that the M&A guidance is hard to navigate, but we had not heard that before. That came up at the October 2025 NAC meeting. Again, there's some unique attributes for not-for-profit consolidations and mergers. There's still the merger guide. There's still merger guidance exists, and even when there's an acquisition, the recognition of goodwill is limited in certain cases. So we also just wanted to understand better the navigability issues there and what we could do. Again, I understand that maybe going into the nitty-gritty here is a little too hard at this point, but just generally, what is it that we could do to reorganize this? And that would be, so the next slide for the questions. Do you have any feedback or specific suggestions as a starting point for this issue?
Okay, thanks, Jeff. Look to see if we have some specific feedback. If we could, as Jeff said, we've over 2 or 3 meetings, some NAC members have raised, and even before that, folks have raised concern about navigability, sometimes about outcomes of the consolidation guidance. Mergers and acquisitions, not as much, really mainly at the last meeting. Anyone want to give any specifics here, just anything that would help as our staff tries to continue our work in bringing this back to the board for discussion? Any volunteers? Okay. Right. We will then, as I said, we'll be probably reaching out to some of you offline for more specific feedback. But okay.
Thank you.
Now, something tells me that the other 2 topics, which I am teeing up, we may have a little bit more to say about, given our discussion already in this meeting. And so let's move to the next slide. I'm just going to briefly tee up liquidity disclosures and operating measures. Not that we've already been talking a lot about operating measures, but let me just give you a little bit of background, a little bit of historical context here. So on liquidity disclosures, this is an issue that was mentioned at NAC meetings during the agenda consultation process over the last year or so. These disclosures became required following the issuance of ASU 2016-14, which was the significant not-for-profit focus standard that made targeted improvements to the not-for-profit financial statement guidance that was originally issued in the mid-1990s with Statement 117. What we were trying to do with these disclosures was to bring better information to creditors and other users about the extent to which donor and grantor restrictions, as well as internal designations, could affect an organization's liquidity. The board decided on these particular disclosures, which in essence try to bring together information about the nature of the assets, which is on the asset side of the balance sheet, with the information about limitations that are reflected in the net asset side of the balance sheet. They settled on these, they decided on these after a couple of things. First, the board considered and rejected whether to possibly requiring a classified balance sheet of all not-for-profits and or a segregation within the asset section of the balance sheet, those assets whose use is limited. Those are required for all healthcare organizations, but optional for other not-for-profits. So the board ended up not going with those, but instead going with these types of bridging disclosures, trying to bring information about limitations together with information about nature of financial assets. The board actually also exposed a much more comprehensive disclosure that would have contained information about obligations within the same time frame, but we ended up pulling back from that after stakeholders raised concerns about potential false going concern signals from presenting just those two pieces of information without, say, for example, information about expected revenues and expenses during the period. At recent NAC meetings, and we heard a little while ago, these disclosures, which are a combination of qualitative and quantitative information about managing liquidity, as well as about availability of financial assets to meet general expenditures within 1 year of the balance sheet. Anyway, NAC members recently have indicated that the qualitative disclosures, at least, are becoming a bit boilerplate in practice and may not be providing decision useful information. And additionally, we've heard from some stakeholders that the quantitative disclosures about availability of financial assets may not be as useful as they could be in helping to identify what we heard at one recent meeting, going concern issues. And that was not necessarily their primary purpose, but again, we were hearing about that. Now, with regard to operating measures, I'll tee that up because I think we do probably want to discuss these together. GAAP, as we talked about earlier, does not require not-for-profits to provide a measure of operations. We did have an exposure draft as part of that ASU 2016-14 project, where we did make a proposal. As I indicated earlier, that proposal was a principles-based approach based on mission and availability. And we heard all sorts of mixed feedback. Some liked that proposal, others liked it, except for the additional transparency we were requiring about the effects of internal designations, transfers, and appropriations. Basically, we required essentially 2 operating measure subtotals, and some thought that made things convoluted and defeated the purpose of having an operating measure. And then others said we should not finalize something in this area because either this was too broad, too vague, too difficult to make work, and too one-size-fits-all in a diverse not-for-profit sector, while others indicated that this was not something yet required for business entities, so why should not-for-profits be required to do it as opposed to voluntarily allowed to do it? So for all those reasons, the board didn't finalize something a decade ago and instead just beefed up the disclosures around if you do use an operating measure, if it's not transparent on the face of the financials, what's in that operating measure, make sure you disclose information about that to make sure it is sufficiently transparent. And again, we just heard a little while ago when we were talking about emerging financial reporting issues, the desire, perhaps need, to have something perhaps a little bit more standardized and required in this area. At least that's what we're hearing from some members, but also some cautions about the difficulties of coming up with something across the sector. Again, especially in light of the experience that we had a decade ago. So let's move on to the questions in this area. First about liquidity disclosures. Again, I'm teaming these up together because they do, as Chris Touch indicates, somewhat bleed into one another. So the first question is, do NAC members have suggestions on how the board can improve the quantitative or qualitative liquidity disclosures? And secondly, do NAC members have feedback beyond perhaps what we've already been talking about on whether the board should or should not work to develop an operating measures? If so, some ideas about what might constitute that operating measure. Otherwise, if not an operating measure, is there something else that could perhaps be disclosed to provide sufficient useful information? So again, a lot of tee up, but I wanted to continue maybe the conversation that we had earlier, and perhaps bring in a little more on liquidity disclosures here. Susan, thank you.
Thank you, Jeff. I think from the liquidity perspective, there is so much variable interpretation of words such as general expenditures and available that we see that is part of what is driving the lack of comparability from one entity to another that I wanted to share. So I think maybe tightening down some of the definitions so that there's not so much ability for interpretation could be helpful.
Okay, thank you. Go on.
I just want to echo what Susan said. That was a discussion we had internally, is that we see a lot of variation in what not-for-profits considered a general expenditure, that we thought that might be an area that could be enhanced, whether it's a set definition or a required to have a disclosure within the liquidity as to what the entity is deeming to be a general expenditure, to provide a reader a little bit more insight as to what funds are being used to cover what expenses. But that's an area we've also seen a lot of discrepancy or variation in practice when that disclosure for liquidity.
Okay. Rick, correct me if I'm wrong. Isn't it in the qualitative aspects of that, isn't the approach to general expenditures at least supposedly required?
Yeah, I actually was, that's why I raised my hand, was to talk about that. I think that if I remember right, it says qualitative information as necessary to help complement what's in the quantitative information. So what I was going to add was that I think that might be able to be crisped up a little bit to have certain specific requirements qualitatively to help really tell how it's being interpreted. You know, there was a discussion earlier about restricted gifts being recorded, and if those are sitting in your net assets and you don't back those out, you might look a lot richer as a starting place to analyze, versus if you did back those out, you might look a little bit poorer. So I think that having a little bit more prescriptive guidelines about what needs to be disclosed to supplement might be helpful.
Cheryl, then Vince, then.
Yeah, so I was thinking that, short of getting into the whole discussion about needing a classified balance sheet and trying to stay clear of that, thinking about whether there are some types of ratios that might be helpful, whether it be, days cash on hand, some type of debt service coverage ratio. I know we talked about that a little bit earlier, or years of available net assets that might provide the reader with some information that might be helpful for those who may not be as financially savvy to be able to calculate those types of things on their own. I know generally there are a lot of ratios in like an MD&A typically, so kind of going back to that discussion as well. But if we're not going to have that, then maybe this might be the right place to have some of that disclosures. And then in regards to the question on operating measures, I do agree it is difficult to have a single approach for all not-for-profits. They're so vastly different between healthcare, higher education, public charities, even private non-operating foundations versus private operating foundations. There's just so much variance. It'd be really difficult to come up with a measure for revenue expense, and then some of us don't even have fundraising. And so you'd have to probably create some types of categories in order to, try to come up with some type of an operating measure for each of those. But I guarantee there's still going to be some outliers where it's not going to make sense.
Thanks, Cheryl. Vince?
Sort of picking up on what Cheryl was just talking about with liquidity, I kind of like the idea of a level approach or somehow indicating to the readers the timing that they can use to assess liquidity to help inform their decisions on, for me in the performing arts organization sector, to help inform our donors, who are our primary donor or funders of the performing arts. So give them some more information so that they can make some sound decisions on whether to invest in these organizations. But also, and really what I raised my hand for was to comment on the operating measure. And again, in the performing arts sector, for us, what's unique, perhaps unique from higher education or healthcare, and being familiar with higher education, I can speak a little bit to this. There's some consistency year over year in the operations of those organizations, certainly fluctuation in financial results, but the operations themselves are fairly consistent. Performing arts, that is not the case. One season to the next will look very, very different. So the idea of creating some sort of a standardized approach to an operating measure, while I do support that, I think it has to be in tandem with some other reporting mechanism, and maybe that is an MD&A that helps organizations tell their story, because they will very much look different in the performing arts. They'll look different from one year to the next.
Thank you. Pia, I think you're next.
Yeah, I had raised my hand back when the general expenditure conversation was happening, because what I see in a lot of financial statements is that not-for-profits will just back out of liquidity their full net assets with donor restrictions. But then if some have budgeted uses of those spendable funds in the next year, others may be adding them back in. And a lot of it could depend on the overall financial health of the organization, if they feel they need to add those back in or not. So there's some inconsistency there. I've also seen some inconsistency in the concept of, can you have a negative liquidity, or do you just stop it at zero in that footnote? That leads to other disclosures about potentially improper use of restricted assets. But those are two things that came to mind when I saw this question.
Thanks, Pete. I'll just say that in the couple of years after the issuance of ASU 2016-14, we did have some discussions about this at the NAC, particularly about the notion of general expenditure, and there were diverse views. Some would view it as just unrestricted funded expenditures, basically what you're saying, be backing out all the restricted funded expenditures, and others would say, no, it's our general operations. The funding is somewhat fungible, and it's really what we're backing out is the more unusual, non-recurring type stuff. So there's different points of view, whether we should be narrowing that down through definition or whatever. I guess that's an open question. Okay. Anything else? Go ahead, Rich.
Yeah, Jeff, maybe just a quick question, if you wouldn't mind clarifying. When people discuss MD&A, are they talking about a requirement or voluntary? And are they talking about it would be part of GAAP, meaning part of the financial statements and subject to audit, and therefore a requirement to have it to be in accordance with GAAP, or more just best practices suggested for not-for-profits outside of the financial statements?
Right now, that is the
No, I understand what it is now.
No, I understand. Yeah, I think that aspirationally, as with the NAC 10 years ago or so, some would want it to be part of GAAP. The board did have a research project, did not end up ultimately doing something here. So again, I guess I could ask members, are you looking to have the FASB require MD&A? Like the GASB does? Go ahead, Cheryl.
Yeah, Jeff, I have always thought about how GASB does their MD&A, and it is audited. And so, yes, I would say that having it be required would be something that we would want to discuss.
Barry?
I think, Jeff, that it would be audited. Our preference would be to have it audited as part of the financial statements, but again, in partnership with evaluating the operating measure as well as the liquidity disclosure.
And Pete?
MD&As are marked as unaudited, and auditors look at them to see if they're reasonable in comparison to the financials. And I know GASB has some new guidance or exposure information out about enhancing the MD&A, because I think in some cases what it's turned into is kind of the boilerplate definition where there's not a lot of explanation. May say assets went up because we have more assets. I mean, I'm exaggerating, but having it be meaningful and explain what we're really looking for would be important. So I would have to think more about whether it would be a required or optional, but I'm sure it could be very helpful in some cases for not-for-profits.
Yeah, again, the NAC in its early days unanimously recommended that the board take up a project in this area. We did a research project, found a lot of these same things about inconsistency and so on. Ultimately did not go forward with the project here. So there has been, at least among some, a long-term desire, to have MD&A perhaps beyond just voluntary. Rich, anything else you wanted me to tease out here?
No, that's okay. I just wanted to make sure I was understanding what the recommendation is.
Deborah, did you want to talk about, thanks, Rich. Did you want to talk about the GASB's MD&A?
Yeah, since it came up, this is something I know something about. The MD&A for government's financial statements is required supplementary information, so it is technically not part of the financial statements. Although there is gap for what to put in there, it is not audited, but the auditors have to review it and to make sure it's consistent with what they have audited. We did put out new guidance in just last year in what's now Statement 103. Part of the concern that we found was the MD&A had become very boilerplate for some governments, that it wasn't really becoming the useful tool that it was intended to be. There's only so much you can do from a standard setting perspective of encouraging people to use the MD&A as a tool to tell their story. And so we've tried in the updated guidance with some additional examples and things like that. But ultimately it is up to each government to write their MD&A in a way that meets the requirements, and how well that gives information to the financial statement users might vary.
Thanks, that's very helpful. Appreciate it. Okay, any other questions or comments before we move on? Because I know we are a little behind now, but I think we'll make that up. Okay, if not, let me now turn to our third topic, which is on the current expected credit loss model, CECL. And I think Dan Stuhlemmer is going to tee this up.
Yep. Hey, Jeff. Good morning. Good morning, everyone. So in connection with the ongoing post-implementation review of Topic 326 or CECL, we're asking for feedback on the benefits or costs of implementing and applying the standard. The memo in your meeting materials discusses the history of the credit losses project and the benefits and costs expected by the board when the standard was issued. So I'm going to just briefly summarize that memo to tee up the two questions that we have for discussion. So the CECL guidance was issued in Update 2016-13. It was effective for public companies in 2020 and non-public companies in 2023. Prior to CECL, credit losses were recognized when the loss was probable and reasonably estimable, generally referred to as the incurred loss model. After the 2007 global financial crisis, creditors, investors criticized the incurred loss model primarily for its thresholds that delayed the recognition of losses in the financial statements, despite management expecting those losses. The board in turn developed an expected loss accounting model in CECL, and under CECL, financial assets are carried at their amortized cost basis with a separately presented allowance for credit losses. The allowance represents management's current period estimate of expected losses based on information related to past events, current conditions, and forecasts of the future. The asset should always be carried at the amount expected to be collected. The post-implementation review began immediately upon the issuance of Update 2016-13. The board initially monitored implementation through activities like reviewing financial statement information and formation of a transition resource group to address practice issues in real time. There's been additional feedback we've gathered through direct outreach to stakeholders, surveys, workshops, technical inquiries, and public roundtables in 2019 and 2021. And because of that feedback, there have been several ASUs issued to improve or clarify Topic 326. However, the process, the PIR process remains ongoing, and we're continuing to solicit feedback to evaluate the effectiveness of CECL. So with that, I'm happy to answer any questions on the memo that was distributed, but if there are not, then I'll turn it over to Jeff or the NAC for questions 1 and 2 for discussion.
Okay. Well, we can go forward with questions here. So the questions are on here about whether they believe the current expected credit loss model is providing expected benefits to financial statement users, and any observations about how it's being used or not used, and then similar questions about costs. So let me ask NAC members to weigh in here. This is basically our cost benefit discussion as part of our post-implementation review of the credit losses standard. Go ahead, Rick. Thank you.
I don't think that for most nonprofits, it was a significant lift at all. I think it was an exercise mostly of documenting what was being done. In some cases, there was formally tweaking how they've considered past experience. So I don't think in general it was a heavy lift for most nonprofits. So cost benefit, I don't think there was anything negative for the nonprofit space.
Thanks, Rick.
Others to provide feedback. I will say that when we were on our agenda call, I remember Chris Dutch, who had to leave the meeting early, saying that it was largely a non-event for the nonprofit sector. So those words largely echo what you were just saying. Right. Anyone have any different views? Any of our users want to weigh in about the benefits? Go ahead, Andy.
Speaking as a preparer, not a user, but I'd concur with what Rick said. It was initial lift, just added documentation, what was already done in the healthcare sector for primarily patient AR. It doesn't add much burden, but it does add a little added step in the audit process and scrutiny. But again, once you have it established, it's there. I don't think it adds much more value in our sector because we were already doing a lot of these components.
Thanks, Andy.
Sorry. Thanks. Any others want to weigh in here? Okay. All right, so let's move on to the last topic of the meeting, where we're going to be talking about current projects of the FASB, including some that have been added as a result of the agenda consultation. We're going to start off with the equity method of accounting, targeted improvements, and I'm going to turn it to Edward Garcia, who is going to tee this up.
Thanks, Jeff, and good morning, almost afternoon to everyone. In response to feedback from the 2025 agenda consultation, the board added a project to its agenda last November to improve the operability of the accounting for equity method investments. And thanks for moving to that next slide. Additionally, at that meeting, the board decided the project would focus on 2 narrow scope issues rather than exploring a holistic change to that guidance. The first issue, which is issue A in the memo, focuses on addressing the accounting for equity method investments in partnerships and similar entities. And more specifically, that investments in those types of entities are required to be accounted for under the equity method when a company holds more than a 3 to 5% interest, regardless of whether the company can influence the activities of that investee. And this is as compared to investments in corporations, which are accounted for under the equity method when an investor has significant influence, which is presumed to be at 20%. And we have additional detail on these different thresholds for applying the equity method, including the origins of that guidance, which is included in paragraphs 10 through 14 of the memo. The second area the board decided to pursue, which is issue B, would be to clarify how equity method investors should determine their share of an investee's earnings when the investee has a complex allocation structure. So, for example, in an investee where profits and losses are distributed using a distribution waterfall versus a simple type structure where profits and losses are based on an investor's ownership percentage purely. And as further described in paragraphs 15 through 17 of the memo, determining an investor's share of earnings in these circumstances requires a careful consideration of the substance of the arrangement, and investors often calculate their share of earnings using what a hypothetical liquidation at book value method, or HLBV, which is a method that's not included specifically within GAAP. And I think we already went to the next slide here, which is good. So in pursuing those two areas, which I just described, the staff is exploring various paths forward, which are described in paragraph 18 of the memo. So for issue A, the staff is exploring whether the scope of topic 323 should be changed to establish a single threshold of significant influence for applying the equity method, regardless of the type of legal entity, and whether the qualitative factors of significant influence in subtopic 323.10 would be operational for investments in partnership form entities. And then the paths to address issue B would be concurrently exploring three paths. And so that includes exploring, whether a paragraph in subtopic 970.323 for real estate entities that actually does consider complex allocation structures should be moved to subtopic 323.10, along with any other guidance in that subtopic that should not be industry or transition specific. Also, whether there are any key challenges that could be clarified in the accounting for complex allocation structures, and also whether illustrative examples could be added to GAAP to show how an entity might allocate earnings in these types of structures. So with that, I'll hand it back to Jeff to open up discussion on questions 1 through 3 in the memo that asks NAC members for feedback on the project scope and objective, the path forward, as well as whether there are any not-for-profit issues that we should be aware of.
Thanks, Edward, for teeing that up. NAC members want to weigh in here? Go ahead, Carrie. Thank you.
Thanks, Jeff. I think the only area of concern that I have would be the number of the impact on the accounting and administrative burden with respect to investments in limited partnerships in our endowments if the definition were to change. So I think we just want to keep an eye on that.
Carrie, I know we've talked about this before, but can you just
Sure.
explain a little bit about what's happening there?
Sure. I mean, we use, as was alluded to earlier, with that sort of 3 to 5% of ownership, we sort of use that as a barometer for influence. Although, quite frankly, even we don't, have influence in any of for the most part, most of our partnerships. And so I think changing that barometer, we would just want to understand and, perhaps have some sort of practical expedient on how we address that with respect to investments for our endowment.
Okay, and I'll just connect that just a little more here. Also, doesn't this have an indirect effect on the related party disclosures that you're being asked to do by a regulator?
Jeff, I intentionally didn't bring that up because it wasn't GAAP, but yes, you're correct. So we have, we're actually doing a lot of evaluation for our Department of Education related party disclosure that has to be submitted with our uniform guidance report. So I think just some consistency there would be helpful. But again, that's a non-GAAP disclosure. So,
okay, because they're relying on the things that are in the scope of the equity method as part of the definition of related party, which is
right. That includes the endowment. Yes.
And so Carrie, just to clarify one point, if I can, by administrative burden, are you saying for investments and partnerships using the 3 to 5% threshold, it's a simple evaluation to where if you're above that, you can apply. Whereas if you go to a single threshold and maybe you're below 20% interest, you might have to evaluate whether significant influence exists.
Yeah, exactly right. Exactly right.
Okay.
Ashley?
Sorry, and maybe just to follow on from what Edward said, you made another comment earlier about these are passive investments. So if you had to do that evaluation of significant influence and acknowledging the comments about the work that would take to do that, do you think that you would change the accounting? Like if you had to evaluate significant influence, that your involvement in those entities, you would conclude that you don't have significant influence? Or is it just more work to get to the same conclusion? I'm trying to understand if there'd also be a change in outcome.
Right, Ashley, I was literally going to say the same, how you just concluded your comments. And I think it'll just be a longer path for us to get to the same outcome.
Okay, thank you.
And just to clarify, if it's an investment and you're accounting for it on the equity method, are you picking up all of its operating results on a fair value basis? So even if you move from the equity method to something cost, you're still going to account for it at fair value. So your financial results will be identical. The only thing that will be different is whether you say it's equity method or not. Understand. Thank you.
Thanks. Yeah. I think it's worth asking folks who work in the healthcare field where there are more operating type of partnerships and others that might be other entities that may be subject to this type of a threshold and where they are using the equity method rather than picking up fair value. If this would be something that you want us to pursue. Anyone who work in healthcare want to weigh in there? Go ahead, Dawn. Thank you.
Yeah, I guess from a healthcare perspective, I'm not really sure I'd say there's anything significantly different for that sector. Like I said, the thing that comes to my mind, once again, which is more from an audit, not an accounting perspective, is just the more things that maybe become an equity investment versus just recorded at fair value will be scoped into group audit, which then changes a little bit about the auditor perspective. But from an accounting perspective, I'm not sure more than what you call it and what disclosures that I feel like there's anything special about healthcare versus other sectors within the not-for-profit realm.
Yeah, just my understanding, just perhaps more of these types of operating type investees.
Yeah. To your point, there's probably more that have to be assessed, but I don't think I would say there's anything that would pursue me to say I think healthcare, there's a reason why we'd want to pursue it more than others.
Any other comments here? Any other feedback for Edward? Absolutely. Okay, if not, let's move on to the next project, which is on classification of certain digital assets such as stable coins as cash equivalents. And I'm turning it over to Rosemary St.
Great, thanks so much, Jeff, and good afternoon, everyone. Before we jump into the issues that the board is working on here, I just want to give a bit of background on this topic. So as you're all aware, the board issued guidance on crypto assets a couple of years ago in 2023-08, ASU 2023-08. And I'd say that's been pretty well received. But this is a pretty rapidly evolving area. And as part of our 2025 agenda consultation, we got quite a bit of feedback from stakeholders that there are a number of issues that they would like the board to look into. And in addition, there was a report issued by the Presidential Working Group on Digital Asset Markets that referred certain accounting issues in this area to the FASB for standard setting. So those issues are listed on the slide. Two of them were added as technical agenda projects to the board's agenda last year. The first is classification of certain digital assets as cash equivalents, and the second relates to crypto lending transactions. And there's both a derecognition issue in there as well as a measurement issue. And then there are a number of other crypto-related issues that were raised, including tokenization of real-world assets, and then from a revenue perspective, gross versus net presentation for intermediaries for certain crypto transactions. And those are issues that, because they were raised as part of our agenda consultation, we will be bringing those issues back to the board at a future date, but they are not currently captured in either one of our agenda projects. And then just a word on regulatory developments. One notable development is the issuance of the Genius Act that was passed into law in July 2025. That establishes a regulatory framework for defining payment stablecoins and permitted payment stablecoin issuers. And the process that's going on right now is that there are a number of regulatory agencies that are working on creating frameworks based on that, on the passage of that law. So moving on to the next slide. So just to level set a bit in terms of our project on whether certain digital assets can be classified as cash equivalents. So first, we do have a master glossary definition of the term cash equivalents. They're defined as short-term, highly liquid investments that are both readily convertible to known amounts of cash, and so near their maturity, they present insignificant risk of changes in value due to interest rate changes. And cash equivalents classification is elective, and there is a policy disclosure if that election is made. So some stakeholders have told us with respect to this issue that there are some potential differing conclusions on this in practice. So we've heard that depending on the terms, the conditions, and the rights conveyed through certain stablecoin arrangements, for example, they can be classified as cash equivalents, intangible assets, financial assets, or derivatives. So stakeholders are looking for more clarity and consistency on this issue. So moving to the next slide. So the board added this project to its agenda in October 2025. The goal is to clarify whether certain digital assets, such as stablecoins, can be classified as cash equivalents. During that meeting, the board talked about a couple of different ways it could do that. One might include expanding the definition of the term cash equivalents. And another path is to create examples to illustrate the application of the cash equivalence definition to certain digital assets. So as part of that meeting, the board gave the staff some direction to focus on the examples approach. And their view was really that potentially revising or changing the core definition could lead to some unintended consequences. At least that's being applied today to a number of different things. So since that board meeting, the staff's been conducting outreach and doing some research on some potential illustrative examples and considering the characteristics of stablecoins that might be relevant for determining the classification. Some of those characteristics are whether there's sufficient reserve assets held by the issuer, as well as the nature of those reserve assets, in particular, whether the reserve assets are short-term and highly liquid, and whether the holder has the ability to redeem from the issuer on demand at par or $1. So we're still in the midst of that. The staff plans to go back to the board in the near future to start deliberations on this project. And I think that's probably all I have in terms of my introduction. And I'd like to turn it back to Jeff to discuss the 2 questions that are on the slides.
Yeah, thanks, Rosemary. Really appreciate that. Let me turn it in turn over to NAC members to give us their feedback on these questions. First of those questions has really to do with incidents as well as pervasiveness as well as any unique issues. And then the second one's where further questions about the project. Go ahead, Rick.
I actually had 2 conferences this week that I was leading. One was in Philadelphia and one was in New York. And when I gave the 25-minute gap update, I mentioned this was on the agenda. And I just kind of polled the room to ask how many people are receiving anything like this, because I was curious what the prevalence was. And there was one hand that went up out of about, in both groups, call it about 60 people. And the one hand that went up said that we accept it as gifts, but we liquidate it within seconds of getting it. They don't want to hold it at all. They're like against it, but they just don't want to turn the money away. So not a lot of prevalence at all. My client base, I haven't seen one client that is holding it. And I don't think I have any that have currently received them as gifts either.
Yes.
I'll just second what Rick shared. So we will accept a gift of crypto, but we convert it to cash immediately. So we won't hold it in that form. And I think that's fairly consistent among the performing arts organizations, which, incidentally, given our donors, it's not uncommon that we may receive that type of a gift, but the practice is to convert that to cash immediately.
Susan?
I'll also echo, we do see it as gifts and contributions. We're actually seeing it more and more, I'll say, with each audit, but agree that it is getting liquidated immediately.
Diane?
Just ditto to everything that's been said. Any conversation I've had around this, clients are liquidating it right away. Similarly, as to when they get certain stock donations that they liquidate right away, they do with the crypto.
Not?
We were actually using a third-party intermediary to accept the gifts on our behalf. They were liquidating it immediately, but over the period of the last several years that we were doing that, we actually stopped because our payment to actually have the vendor was more than the gifts that we were actually receiving via crypto.
I guess I would ask if there's some conflation between crypto generally and stablecoins specifically, and sort of the purpose differential between the two, right? One is sort of a speculative investment versus the other being maybe like a mechanism to conduct on-chain transactions, right? So I do think it's important, as this is discussed, that there's differentiation between crypto generally and stable coins. And I would say even more specifically, as you look and evaluate cash and equivalent treatment, regulated stable coins in which you have one-to-one backing with eligible reserves and segregation of the reserve assets from the issuer's insolvency risk. So I think just as you tip your toes in this water, I think being very sort of diligent about what sliver of it would get cash treatment from the larger discussion around crypto.
Harry, can I ask you if what you're seeing or hearing from colleagues in the higher education where I was thinking of any place maybe they'd be holding some of this, but perhaps not?
For the most part, if we're accepting them, we're liquidating them as soon as we have them. We are seeing some develop policies around the acceptance and possible holding, but they're so not material to the financial statements at this point. I just think that that's an area of risk that the industry really hasn't, gone down that path yet, other than immediate liquidation.
And to Robert's point, any differentiation in those discussions between like regular crypto or stable coins specifically? Stable coins?
No.
Not yet. Okay. Anyone else want to weigh in here? Okay, if not, thanks, Rosemary. Let's move on to our next topic, one the NAC talked about at its October meeting, which is the project and application of topic 715 to market return cash balance plan. So I'm turning it over to Michael DeMarco for this.
Thanks, Jeff. Good afternoon, everyone. Next, I'll provide an update on our project on market return cash balance plans. As Jeff mentioned, we gave an update back in October to this group after the EITF made recommendations to the board on how to address the discount rate used to measure the benefit obligation for certain market return cash balance plans. For today's meeting, we'll focus on the more recent developments. So let's move to slide 31, kind of the tentative board decisions. So just 2 more slides. Perfect. So in January, the board added a project and completed initial deliberations with the following decisions. To be considered in scope of the proposed measurement guidance, the plan must meet both conditions listed on the slide. In addition, an NAC would be required to use the assumed interest crediting rate as the discount rate when it meets the scoping criteria. There would be no additional disclosures, and the board voted to require prospective transition with early adoption permitted. As listed on the slide, an exposure draft is expected to be issued next quarter. On the next slide, there is one question we are seeking input from NAC members. With that, I'll turn it back to Jeff.
Okay, thank you. And that question is on the slide. Really, do you have any questions about the amendments to be made under this project? I remember at the October meeting, we did have one NAC member in particular who had some comments in this area, but actually rolled off the NAC at the end of December. I don't know if anyone currently on the NAC wants to weigh in here or ask questions really here. Go ahead, Robert.
Yeah, I followed up with our pension expert on this question in particular, and I guess just in how he interpreted this, he was wondering if there's a reason this treatment is limited to cash plans, the assumed interest credit rate, opposed to sort of more traditional defined benefit plan treatments on how discounting occurs.
So I think on that, I think the EITF identified specifically market return cash balance plans where the use of not using the assumed interest crediting rate as a discount rate was resulting in the plan's economics the economics of the plans not being reflected accurately in the financial statements. So that was why that was a specific issue identified versus the larger plans of following the same pension accounting. And I think part of the issue was to stay narrow, and that in the market return cash balance plans, in many cases, the interest crediting rate is tied to the return on investment. So that was one of the main distinctions there.
Yeah, and if I can just follow up on that, I think that was his view effectively. That is a more accurate reflection of. But then he asked, essentially like, does this have broader implications around, what FASB might want to do, more broadly for pension plan discount rates.
And I think the intention was to be a very narrow scope project for these specific set of plans.
Any other feedback, questions, comments here before we move on? Okay. If not, let's move on to something we also talked about at our last meeting, and that is the PCC's research on subjective acceleration clauses. And I'm turning to Ashley Allen for that.
Great, thanks, Jeff. As Jeff mentioned, at the October NAC meeting, we provided an overview of the current guidance on subjective acceleration clauses, or SACs as I will refer to them, and determining the classification of debt as a current or non-current liability in a classified balance sheet, and discussed the status of the PCC's research project on the issue. NAC members noted that while classified balance sheets are not common for most NFP entities, SACs are included in nearly all debt arrangements of these entities, although they are rarely ever enforced. Since the October NAC meeting, we could go to the next slide, please. Thanks. The PCC further discussed the project in both December and March. At the March meeting, the PCC voted to recommend that the board add a project to its technical agenda on the issue rather than the PCC continuing to lead the project. This was based on feedback we received from stakeholders, including yourselves, that the issues apply to all entities and are not unique to private companies. The PCC also made the following recommendations to the board: to remove the probability-based assessment guidance, and instead, SACs would affect the classification of debt only when triggered; to describe triggered as when a lender demands repayment of the underlying debt because of non-compliance with the SAC; to require that long-term debt subject to a SAC be classified as a current liability when the SAC is triggered; to add an illustrative example of the application of the subsequent events guidance; to make conforming changes to the intent and ability to refinance guidance so that SACs only affect the classification of debt when triggered in these scenarios; and to make conforming changes to the guidance on revolving credit agreements with SACs to be trigger-based; to require disclosures in the period in which a trigger of a SAC occurs, including a description of the event leading to the trigger, an explanation of the trigger, the amount of obligation subject to trigger, and if applicable, the terms of any waiver. And lastly, the PCC recommended permitting a prospective transition method with a consideration of also allowing an optional retrospective application. At a future board meeting, the issue, including the PCC recommendations, will be discussed by the FASB for an agenda decision and initial deliberations. So with that brief introduction, I'll turn it back over to Jeff to lead our discussion question, which asks whether NAC members have any questions or comments on the recent activities of the PCC's research project.
Thanks, Ashley. And again, especially NAC members who are with or have clients who do classified balance sheets. Anyone want to weigh in here? Any questions or comments? Nope. Wow, not too talkative today. Okay, at least on this as opposed to operating measures. All right, so let's thank you, Ashley. Let's move on then to debt modifications, and then I'm going to turn to Chris Bodan for that.
Excellent. Thanks, Jeff. And we can advance to the first slide. So in connection with both the PCC's research and the board's 2025 agenda consultation, we've received significant feedback on the borrower's accounting for debt restructurings, and that is intended to encompass the borrower's accounting for troubled debt restructurings, which we refer to on the slide as TDRs, as well as the guidance in subtopic 47050 on debt modifications and extinguishments. These areas of guidance apply to all entities. As a quick reminder, when there's a debt restructuring, an entity has to first consider the TDR guidance, which applies to entities that are experiencing financial difficulty and receive a concession from their lender. The TDR guidance has its own accounting model and disclosures. And if a transaction is a TDR, the financial effect of the changes to the loan are generally accounted for prospectively through future interest expense. However, if there's a significant enough concession, it's possible that the borrower would have to recognize a gain upon restructuring, with all of its future repayments treated as principal reductions for accounting purposes. And in that scenario, there's no future interest expense recognized. Separately, if a transaction is not a TDR, it's usually subject to the guidance in subtopic 47050 on debt modifications and extinguishments, and that guidance requires application of a 10% cash flow test. The outcome of that test determines if the changes to the debt are accounted for prospectively through interest expense, or whether the old loan is treated as extinguished. So when the old loan is treated as extinguished, an extinguishment gain or loss is recognized, and the new debt is measured at fair value. So with that as background, we've heard feedback that there's challenges in determining whether a transaction is a TDR. There's been some questions about the usefulness of the outcomes under the TDR guidance. And we've heard feedback that applying the 10% test in 47050 can be very difficult. So as a result, some stakeholders have suggested either eliminating or modifying the TDR guidance or eliminating the 10% cash flow test. And to that end, during the March PCC meeting, some board members discussed an approach under which extinguishment accounting could apply more broadly to modifications and exchanges, but with simplifications for how the new debt's fair value is determined. Also at that PCC meeting, PCC members acknowledged that the board plans to discuss this topic further at a future meeting and agreed to postpone its research until that meeting occurs. With that, we have several questions for NAC members on what is now this slide, and I'll turn it over for discussion.
Okay. So you can see the questions that are on this slide about feedback related to TDRs and debt mods, about whether you have views on applying a model based on extinguishment accounting, again, with some simplifications, and are there any not-for-profit specific considerations related to these topics that the board should be aware of? Anyone want to weigh in here? Go ahead, Dawn. Thank you.
Yeah, I was just going to share, except in the sector that I worked in, we don't usually see a whole lot of TDRs, but in the situation where we have, they have been very complex to go through the calculations for management of the entity. So we'd be very supportive if, anything that's simplifying the model, but still provides useful information to the reader and, isn't really misleading anything as to recognition in the financial statement. So, like I said, we couldn't come up with any really downsides with the proposal at this point in time.
Okay. Anyone else have any feedback here? Go ahead, Andy.
I would just echo what Dawn said as prepare just the tedious exercise to go through the 10% and even the requirement on the holders themselves and concentration and getting that detail, especially in the public market, would just very much simplify that overall accounting. Because again, I think it's rare that it usually comes into a TDR situation anyways.
Any other NAC members want to provide feedback here? If not, I think, Chris, you can move into our last project, which is on definition of common control.
Perfect. And I think we can go to our next slide. So also in the 2025 agenda consultation, we received feedback that while the term common control appears throughout GAAP in various contexts, it's not defined in the codification. Instead, subtopic 80550 provides several examples of transactions that qualify as common control transactions. And in one of those examples, the guidance states that a common control transaction would be exemplified when there are two or more NFPs that are effectively controlled by the same board members. They transfer their net assets to a new entity, dissolve the former entities, and appoint the same board members to the newly combined entity. So despite that example being in the codification, we understand that in practice, the term common control is interpreted more broadly and includes fact patterns that go beyond those that are illustrated in the codification. Consequently, stakeholders indicated that the board should prioritize defining the term common control, and in January, the board added a project to its technical agenda to add a definition of common control that is based on existing practice. While we've received feedback on potential solutions in the context of business entities, we wanted to hear from NAC members to learn more about how NFPs interpret the term common control. For example, in topic 805, the term control is defined as having the same meaning as controlling financial interest. However, we expect there's potentially more nuance for not-for-profits. For example, for the purposes of applying the guidance on relationships with other NFPs, the Master Glossary defines control as the direct or indirect ability to determine the direction of management and policies through ownership, contract, or otherwise. So now that we've already moved to the flowchart slide, what we've illustrated on this slide is, again, a flowchart adapted from existing guidance in the codification that NFPs consider when they're evaluating a relationship with another NFP. One key takeaway that we had from the slide was that in the context of NFPs, the terms controlling financial interest and control aren't necessarily defined as being synonymous. And in addition, we're aware that there are scenarios where consolidation may be permitted or encouraged, but not required because there is control via majority voting interest in the board of the other NFP. Those scenarios are precisely the ones that a lot of our questions are framed around that we'd like to gather more information about. Particularly, as we get into the next slide, it'll be what's essentially in the yellow box on this slide and in the red box on this slide. And with that, we can move on to the questions for our NAC members.
Yeah, and just as an example, we're particularly talking about if it's not majority board control, it's typically controlled by contract or some other means. And that's kind of the scenarios that Chris is alluding to there. To the extent you guys have experience with that, well, we'd love to you to weigh in here a little bit. So there's a series of questions. Do you experience challenges using applying common control definition? And then some of the scenarios that Chris was talking about where consolidation is not required because it's not majority board control, but permitted or encouraged. Or if there does house control but not an economic interest, however frequently that is. Or other unusual or other unique issues. That's a lot on there, but anyone who has experience with this or wishes to weigh in, that'd be great. Thanks, Robert.
Yeah, I guess, Chris, on your comment around, direct and indirect control, and then we have this third box where it's essentially tying to majority voting interest. I'm thinking of, overlapping management or things that aren't necessarily board level control, but are clearly connected from an economic interest perspective. And so, I guess what's the thought on a bright line for majority voting and making optional these other situations when it's clear there is a clear economic interest alignment, and if not a majority voting interest alignment, some substantive means to exercise control.
I think at this stage we're trying to better understand what the current practice is in some of these more nuanced scenarios. So I think as a starting point, we would try to understand are those types of scenarios resulting in entities concluding that the two entities are under common control, or are they not? I think that would be an important starting point before we would start to think about, okay, then what would the actual guidance that goes into the codification look like? I think that's kind of for both business entities and for not-for-profits. I think that's grounding our next steps on this.
Robert, just for perspective, that guidance where it's treating it differently, that actually is 30-plus-year-old guidance that actually I think the AICPA originally worked on in the 1990s that was ultimately codified. So I don't, again, I don't know if we have a lot of insight into the nuances of why consolidation is required in one instance and not otherwise. But as Chris said, we're trying to look forward and see what should it be, what should it be, what can we do?
Yeah, and I can just follow up, from our perspective, we're looking through our substantive view of the situations, and so we would maybe be more comprehensive in our expectations around consolidation when there's direct or indirect, we would be pushing maybe to bring those in and not necessarily carving out if it's just sort of strictly a majority voting interest.
Any other feedback here? I know we're just about at time, but I just want to not cut this off prematurely. Okay, if not, thanks, Chris. Really appreciate your teeing up these last couple of issues. And so I wanted to thank our NAC members and observers. I wanted to thank our board members. I want to thank our staff who participated, as well as anyone who tuned in to the live stream for tuning in. And I wanted to let you know that our next NAC meeting, tentatively scheduled for here in Norwalk, but again, that hasn't yet been determined, is on Tuesday, October 6th. And with that, I wish you all a great summer and please stay safe and well. The meeting is adjourned.